We're going to tell you how to research stocks, or at least we're going to try. You see, every investor has the same problem. There's tons of data. There are tons of formulas, ratios, analytical techniques, all these different things you can look at and all these different ways you can look at them. But how do you prioritize it all? You can't look at every data point. You can't use every formula, every method. You have to make a lot of tough decisions to dial in an investment process. And my friend Todd Wenning is here to help us unpack this today. Todd is the founder, president, and CIO of Ohio-based KNA Capital Management. That's an RIA. He is the publisher of the Fly Over Stocks newsletter on Substack, one of the most popular investment newsletters on Substack, I believe. He's also the director of the Hanley Center for ESG Investing at the University of Dayton, and he's a lecturer of finance there too. So Todd, welcome.
Thanks, James. Great to be back on the show.
And as a fun fact, Todd used to live in the small town in northern New Jersey where my dad was born. So when was the last time you were in Rivervale, by the way?
Last summer, actually, we took a road trip out to New Jersey and went to the beach and went up to Bergen County. And it was great to be back in Rivervale, see some old folks.
Awesome. Awesome. So let me frame our topic today. And I got into it a little bit, the intro, but when I started out my investing career, I was an Excel monkey in every sense of the word, or I don't know how many senses of the word there are, but I was an Excel monkey in that my hedge fund boss gave me a big spreadsheet to populate with numbers from a printed out 10K. We used to print out the filings in the old days, a big stack of filings, and you'd go through and type them in one at a time. And I'm sure there's some higher than we would like to think error rate. And like I was doing work, but I like many people new to investing, I didn't really yet have that broader contextual knowledge of what matters, what's not, like what doesn't matter, what's important, what moves the needle, what doesn't. What do you think the number one mistake most investors make as far as process or prioritization goes is?
I think the biggest challenge, and it's one of the things I addressed in my recent blog post, is knowing when you have sufficient enough information to make a decision, a buy and sell decision in your portfolio. So some people that are very risk averse, they might spend weeks, months looking at a stock, and I haven't figured out the 96th percentile of information that I need to feel confident in buying this stock. On the other end of the spectrum, you have people who look at a PE ratio and buy, right? And so there's this wide spectrum of how much research people are comfortable doing before they're ready to make a decision. And so part of it is knowing yourself, and part of it is getting comfortable with analyzing companies, knowing when you have enough information to make a decision, knowing that you'll never have 100% knowledge about a business. And that's always the biggest challenge as investors. We're always trying to figure out the future, which is uncertain, and we're making our best guesses. And sometimes that comes true, sometimes it doesn't. Sometimes it's better than we expected, sometimes it's worse. And so that's, I think, why a lot of people have this very disparate sense of appetite for taking risk based on their research.
It sounds like a subtext of what you're saying is the process matters more than people probably think. So maybe a mistake is underweighting process. And by the way, I was thinking of Rivervale. My dad is totally, what you said brings my dad to mind. He'll have very good ideas, but he'll just be like not ready to commit, just kind of like a little hesitant. And then the thing will happen and maybe he'll jump in a little too late. And we would admit this too, if he were like sitting next to me. So if I gave you a continuum, Todd, on one end of the continuum, certain life decisions we make, like getting married or buying a house, we don't make them in a spreadsheet process kind of checklist way, right? You kind of you got the feeling you've known somebody for a while. All right, good enough. Let's get married. On the other end, and hope maybe it's more than that, but on the other end of the spectrum would be, let's say, a McDonald's restaurant. And this is going to sound like a backhanded compliment, but I mean it purely as a compliment. You take people who maybe are not, top tier educated people, maybe they're not the most motivated people, but yet you put them together in this system, and this system works so well that they can really, really effectively run this business because the system is just awesome, right? And so, maybe in the ideal, I guess my question would be, where do you put investing? Like all process compared to, kind of gut feel decision, like where on that continuum do you think investing ideally is?
Yeah, it's a good question. I think part of the issue is also thinking about how much of my portfolio should I put in an idea, right?
Hmm.
So uh, one of the things I suggested in my blog post was that to have a certain have a process in mind about, okay, I'm comfortable buying, say, up to 1-2% of my portfolio in a company that sort of has great pattern recognition for me, that hey, it starts checking boxes, looks like it has a moat, looks like it has a good brand, looks like people are buying it at the store, looks like the stock is relatively cheap. I'm willing to just take a chance on that with a 1 or 2% position. Now, you also don't want to do that with 10% of your portfolio in one single idea. So what I suggested in the post was that as you get more comfortable following a company, as you learn some more of the nuances, maybe you go from 60% of the information that you need to 80% of the information that you need, then you start to add a little bit more to the portfolio, because now you can follow along on the earnings calls. You understand everything management is talking about, everything that there's no metrics that you've heard for the first time, that the analysts are asking questions and you kind of understand what the issues are. That's when I think you can get a little bit more comfortable with adding more towards your portfolio. So it's not necessarily all about having the information to make a decision. It's okay, based on that, how much am I comfortable investing at a given time? Because there are certain companies I'll look at and I followed for a long time from a distance, maybe, and all of a sudden the stock gets cheap, and it has all the pattern recognition, bells and whistles that I look for, and I'm not ready to make that a 10% position, but I'm more comfortable saying, okay, I want to put a little money in here, let my pattern recognition go to work, rather than say, oh, I'm gonna wait. I'm gonna do some more research. I'm gonna spend 6 months researching the stock before I buy it. And what we found, especially over the last 20 years or so in the markets, is that especially with quality companies, the opportunities to buy them cheap, if they happen at all, are usually pretty brief, unless there's something seriously wrong with the company. And so there is a bit of necessity to take an action, and that's one of the conundrums with investing, right? We we sort of promote this idea of being patient, right? Being prudent, long-term, patient investors. But there are times when you do have to take action. And Warren Buffett's talked about in the past, when you see opportunity, when it's raining, you don't go out with a thimble, go out with a bucket.
Yeah.
And so you want to be patient, you want to be long-term focused, but there are times where action is required. And so a
Kind
good
of like
thing,
hunting, right? Like it's boring as heck. I don't know. Most people probably aren't hunters, but boring as heck most of the time. And it's extremely exciting for like a 1% of the time.
right, right. And so if you're running around in that boring time trying to make things happen, nothing's going to happen. And so you have to be able to balance that patience with taking action when action is needed.
Yep.
And so to circle back to your original question, where does investing land on that spectrum? I think it really depends on a number of factors, right? Your personality, how much you're comfortable making an investment, how much of your portfolio are you willing to put in, how long you've been, how much experience you have. There's all sorts of factors that go into that. There are people very willing to invest on 2 minutes of research, and other people who are unwilling to invest at all with 200 hours of research. And so it can be very different for different people.
And I like the idea of buying a little bit because that kind of gets some skin in the game. And then you pay more attention in a way that you don't if you were just following the stock. So let me ask you a highly biased question, or a question that, of course, you're going to give a highly biased answer to, I should say. And that I could have Todd Wenning here. I could have a chart guy here. I could have a macro guy here. I could have a distressed, bankruptcy kind of focused investor guy. Each person is going to give a different answer to this question. This is factors, right? Factors I'm thinking of as reasons we buy, hold, or sell stocks. It could be anything from CEO haircut to price to earnings to ROE. Of course, in real life, academics mostly talk about numerical factors because they're the easiest to standardize, to quantify, to put into a spreadsheet. But in principle, the factors could be anything. So in framing a question of like, how do I prioritize? How do I do a research process? Let me first ask you, if I'm coming from outer space and I just want to know like your rough list of factors in 1 minute, like the things that you're looking for, the pattern that you're looking to recognize in future stocks, how would you answer that?
For me, it really starts with the economic moat. That's one thing that for most of my career I've been focused on. So probably the earliest phase was maybe in the mid 2000s, but certainly when I started working for Morningstar in 2011 and being sort of immersed in that regular conversation about moats. I mean, moats were just happening all over the place. We're talking
Mhm.
about it in meetings and in our analysis. We're just always thinking, how does this company's moat show up? With one of the five factors. So that's network effects, switching costs, intangible assets, low cost production, and efficient scale. So first thing I want to do when I look at a company is figure out which bucket it might be in,
Mhm.
looking at its historical margins, its returns on invested capital, returns on equity. If those are all very positive and giving the appearance of having a competitive advantage, then I want to figure out, okay, which bucket does this likely fit into? And so that's where that's the first filter for me. I'm am not interested in investing in a company that has a great management team but no moat. The moat to me is what continues, because the management team, the average tenure of an S&P 500 CEO is like 4.5 years, five
Yeah.
years.
Yeah.
So they're going to turn over, but the moat is what gives management, a good management team, time to respond to changes in the market. And so
And how would you know if it has a moat? I mean, moat obviously is some sort of protected competitive advantage, like a moat around a castle was. And I think it's a Warren Buffett term.
yeah,
Um, if I said ROIC, return on invested capital, in excess of weighted average cost of capital or in excess of industry ROIC, something like that, is that good enough, or is there a different way you define or measure a moat?
that's generally a sign. So if you're looking historically and a company's generated low double digits returns on invested capital and its cost of capital over time has been like about 8%, that's usually a sign the company's doing something a little bit interesting, at least,
Mhm.
and it's important to investigate what that might be. Now, there are certain companies that, especially younger companies, where they have not started generating accounting profits yet. And so you don't see that return on invested capital present, but using the moat framework, you can start to think, okay, what moat are they building toward? Are they
Mhm.
building toward this switching cost advantage, for example, where it just costs me so much money to change my provider once I'm using this product all the time? And so you can start to think, okay, the company's historical financials, if it has any, right, it might be a newer company, does not indicate to me that it has a moat. But there are qualitative factors that I've seen elsewhere work that suggest that this company is working towards a moat. And if you can find those can be very, very valuable investments, because what the market typically responds to are changes in the return on invested capital trajectory. So if a company has a 10% ROIC and it's moving towards 20%, the market tends to reward that because that company is generating more and more distributable cash that can ultimately be returned to shareholders.
And
So,
just to double click on that, like if I'm new to investing, the reason is that, and correct me, Todd, if I'm misspeaking for you here, but expectations that are already priced in to stock prices, basically. So the way you get rewarded is by the company doing something that's not expected. So if they expect 14% ROIC and instead it does 16%, that'll be rewarded. Whereas 13%, which might be still pretty good, might even be punished a bit.
right, there's a great book and some papers by Michael Mauboussin on this concept of expectations investing, where each stock price, if you believe that the present value of a stock is the future cash flows discounted back to the present, the stock price gives you an implied DCF, discounted cash flow. It's saying that based on this price and based on what I think the discount rate is, these are the cash flows that are currently priced into the stock. And if the company does better or worse than that, that's really what's going to move the stock over time.
So if I'm watching this and I'm just somebody who says, just tell me the number, tell me what to look for. You would start with ROIC, compare that to WACC. And by the way, those are fairly heavy duty calculations, although I think these days they're probably a lot more automated sources of these data points, but it's still kind of good to know the mechanics behind them. But let's pretend, you're just beaming in. Besides that, what are some of those qualitative ways to measure moat?
So I also look at the margins. A company that's
Mhm.
generating 60, 70, 80% gross margins is probably doing something pretty well. If they're
Yeah.
able to mark up their inventory that much when they sell it. Companies that have consistently high net income margins. One of the things I teach my students in my corporate finance classes is the DuPont analysis, where you take the return on equity, which is net income divided by equity, and you break it into its components. So that's net profit margin, asset turnover, and the equity multiplier. So the net margin is the net income over sales. The asset turnover is sales over assets. And then the equity multiplier is assets over equity. So the equity multiplier represents the leverage that gets kind of put on top of the underlying business, so to say. So the business is doing the net profit margin times the asset turnover. And so most companies kind of fall in this kind of curve where they either have very high asset turnover and very low margins. So you can think about Walmart, for example, right? They don't have a big markup on their items, but they sell a lot of it. You know, they stack them
Yeah,
high.
like a supermarket. Yeah, same idea.
Stack
Yeah.
them high, sell them cheap. And then on the other end, you have a company like Ferrari, right? That spends that has very high margins, but doesn't have a lot of turnover. So people aren't buying Ferraris like they do milk at the store, right? And so you have two kind of general business models. One is kind of so the Walmart would be kind of more of a cost structure, right? It's a low cost advantage if they're able to generate high returns on equity by having a low margin, high turnover business. And same thing with Ferrari, if they're able to generate high profit margins and maybe not have a high turnover, but their turnover is fast enough where their returns on equity remain very good. So I generally look. So if I was going to suggest, a starting place for ROE, I would start with 15%. Look for a company with 15% ROE, along with relatively low leverage, right? So if most of their ROE is coming from their business operations and less on their how much leverage you're putting on top of that, that tends to be an attractive business. And so if you can find a company generating consistently 15 plus ROE each year, that's usually a good place to start.
And so beyond that, what are some of the other factors you'd like to see before you're ready to click buy?
So again, going back to the moat, I want to double check, make sure that I understand, a 360-degree view of the moat. So that's just not how wide is the moat, meaning how intimidating is it for somebody else to want to take on this business? So, if I'm looking at Meta Facebook, for example, if I'm trying to compete with Meta, I'm not even going to get started because they just have such a dominant position in that space. And then I'm looking at the moat width. Let's say I do want to take on that company. How difficult is it for me to do that? And then the third thing is the moat trend. Is it getting stronger or is it getting weaker? Do I think, in other words, over the next 3 to 5 years, is this company's competitive position going to get stronger or weaker?
Trend is super important.
Yes.
Yeah.
Because that goes to that ROIC trend that we were talking about. So a company that's getting harder to compete with should have increasing ROICs, which means that the stock price should respond to that. So if you can get that correct, which is not easy to do, it tends to be very, very lucrative.
So are you pretty much a moat man then, or do you do any DCF or price to earnings analysis, look at the management, compensation structure? I mean, there's a million different things we could be talking about here, but you've mentioned moat, you've mentioned margins, you mentioned returns on equity, excuse me. All the other stuff, is that kind of along for the ride? Like if you satisfy these initial criteria?
So when I did a Venn diagram a couple of years ago where I sketched out my philosophy, and it's sort of a Venn diagram of moat, management, and price or valuation. And so once I'm confident in the moat, then I turn my attention to the management team. Do I think the leaders of the company have my best interest as a shareholder in mind?
And how do you determine that?
Good question. Are they allocating capital in a way that supports shareholders, right? Are they taking the cash flow that the moat is producing and making their competitive position stronger? Are they making smart acquisitions? Are they reinvesting enough in the business through R&D, through advertising, whatever it might be? Are they repurchasing stock at attractive prices historically? A company that...
Which is super, super rare, by the way. Yeah.
It is very rare because a lot of times buybacks are pro-cyclical. So when the company's doing really well and the stock price is high, they got a lot of cash, they're buying back stock when it's expensive. And then when the stock is cheap on the down cycle, they start holding cash.
They buy it back when they have the money or they want to cover up the options dilution.
Exactly.
Okay, so let me just click on something though. You said it was kind of getting to the point of like operational returns. How good are they at allocating capital? In terms of numbers, like how do you decide that? Is it returns on incremental capital you would look at? What's the exact data point or data points you would look at to make that assessment?
Sure. So returns on an incremental invested capital is something I look at. Again, that's a fairly advanced, metric for folks to use. But basically, it looks at how much of a change you have in net operating profit after tax from a year to year versus how much capital you employed over that period. So just because your net operating profit after tax went up doesn't mean it was necessarily a great use of capital if the incremental amount wasn't sufficient. So if it was lower than what it's been in the past, that tends to be a sign that management isn't finding as many good reinvestment opportunities as it has in the past.
So if you see that, and if you see management, I would say even let's say they're being very disciplined and not buying back their stock, even though they've got a lot of cash because maybe they think it's rich. I'm guessing, Todd, you would take that as a good sign and say, okay, I kind of like these guys. Is that true?
It's true. I like also looking for what I call owners rather than managers.
Hmm.
So and they don't have to own two, three, four, and 20% of the company. They just have to have an ownership mentality. And so I mean, the most obvious way of noticing that is that they are actual owners. But you can also see if they just truly love what they're doing, and it's not just about the money. As I mentioned earlier, the S&P 500 CEO median's about or tenure is about 4 or 5 years. And so if you can find a CEO who gets in the role and just loves the business and sees him or herself as a steward of the business versus, a part-time owner of the business, part-time mercenary rather of the business, they can really elevate shareholder returns. There's a great quote from Dave Cote, who is the former CEO of Honeywell, and it was in the book Lessons from the Titans, which is a great book, and I recommend everybody read it. When he took the job at Honeywell, one of his early quotes to one of his analysts was, "I want to make money in the stock 10 years after I retire." Right? So he's not thinking about how can I maximize the stock price over the next 5 years and then give it to somebody else and everything falls apart. He's thinking about how can I be a great steward for this business to have it be in a better position when I leave than I found it. And if you can find those qualitative, and again, these are not typically found in the filings. So these are ways, there's more ways than ever to research these kind of things. So there's local business journals, there's Google searches, simple Google searches, AI increasingly, podcasts, videos. There tends to be something out there that you can pull a thread on that helps you understand a little bit more about the CEOs and the CFOs intentions, their character, and if I can sort of square that circle, I feel a lot more positive about getting behind them.
Got it. So if I were replicating your style, if I wanted to make an AI to copy Todd Winning, uh, would 50% or more of the decision be that healthy moat, and then maybe a minority would be all those other nice trappings that are they're sort of nice to have, but they don't compensate for a lack of moat. Is that correct?
Broadly, I mean, it's one of those things. It's more like a decision tree where does the moat yes or no? And if the moat is yes, then we go to management and we go to valuation. And so if broadly speaking, maybe 50, 30, 20, moat, management, valuation. But
Okay.
I see it more as a decision tree.
So you've just landed on Earth from outer space. You have this framework in mind. You have access to whatever a normal individual investor would have access to as far as data goes. Like if somebody put a gun to your head or just encourage you, let's say, to quickly sift through to try to find if a stock, it's speed dating for stocks with Todd Winning. Where do you literally go to first? Is it like Yahoo Finance? Is it a conference call? Is it company's website? Like where would you first go to, and what are you first reading to make that? It sounds like a mode assessment is your first kind of meaty thing. Like how do you do that?
One of my favorite places to go is just to the 10K business overview and start reading and trying to, and comes from experience. And so I don't think someone who's just starting can maybe replicate it as easily as I've been able to over the past 20 years. But as I start reading through a business overview, I can start figuring out, oh, this reminds me of that company, or this reminds me of that company, which had a moat which did really well. And so there's this pattern recognition that you develop over time by turning over rocks all throughout your career, and you can start figuring out this is something I'm interested in, this is something I'm not interested in, and you can pretty quickly discard the stuff that you're not interested in. If there's something, if it's an industry that typically doesn't have great economics, I'm typically not interested unless they're doing something differently. So, for example, the home builder NVR. Typically, I wouldn't own anything in the home builder space, and I don't currently. But NVR is a differentiated business model within the home builder space, and so if you're reading through its business overview and have any idea of what other home builders operate like, you realize they're doing something quite different. And so it's worth pulling that thread and learning more about it.
You and I last saw each other in Omaha at the Warren Buffett Berkshire Hathaway annual meeting. One thing Buffett supposedly does, although this has been partly debunked, but he reads all the time. And Charlie Munger, his former partner, was described as a book with legs. Uh, I read, I forgot where it was, a pretty good blog post saying, hey, Buffett, this is overblown. He actually did a lot of schmoozing, a lot of traveling, especially earlier in his career, and he's made this great network. So it's not quite that he's just this hermit with a book. But that said, I kind of think Buffett spends less time than most people would think, or at least in the past 20, 30 years, just poring over reports. Do you believe that? And if so, do you think it's a case that he's identified just like a few factors that he sees as super, super important, and he just kind of discards the rest?
I think a lot the nature of research has changed substantially since Buffett started in the 40s and 50s and 60s. When you think about what information he had and didn't have access to, and what information was and wasn't available to the general market. I mean, this was all also pre-regulation fair disclosure, where any material public information, material information to the company has to be disclosed to the general public. So by sort of making those rounds, by visiting companies, by going to the library and sifting through the value line letter by letter, you could build up this tremendous resource of information and networks and connections. And today, I think there's just so much information that's available that you have almost the opposite challenge of how do I whittle it down to, so that I minimize the noise and maximize the signal, right? Trying to understand, ooh, that's interesting. I need to figure that out. And so one of the things I've come across is just again going with that moat, right? Thinking longer term. Does this piece of information impact the moat at all? If it's not, I don't pay attention to it. If it does, or it might, I need to dig into it. I need to figure out, is this going to impact the company's ability to do what I think it's going to do over the next 3, 5, 10 years? And so my guess is that Buffett's obviously multiple levels above me, and I don't know exactly what his process is, but my guess is that he has, and he's talked about how he has he loves brands, for example, and he believes in that concept.
And a good brand is a type of moat, right?
Right.
If someone's new to the discussion, yeah.
So there's certain things he's comfortable with. I don't think he's invested in anything with network effects, for example, like eBay or Facebook. There's probably some switching costs that he's maybe not in those words invested in, but brand most obviously with Coca-Cola and Dairy Queen and See's Candies, and those are things that he understands. And I think that's one thing that investors should try to figure out for themselves is what do I understand. And I think that the term circle of competence is thrown around a lot. Like what do I already know, and don't deviate from that. I think that's too limiting. I think you need to figure out, okay, what can I reasonably understand? What experiences have I had in my past that I can learn about? So, for example, I haven't done a ton of work in biotech, but a friend of mine said, well, you've done research into video game publishing. It's sort of the same kind of process, right? Where you're, a small place, you're going to create this big game, and you're trying to get people to buy into it. And there's no regulatory aspect of it, which is different. But he's like, that's kind of the same concept. And so that all of a sudden, dropped those walls a little bit, saying like, maybe I could learn more about biotech if I want to apply that framework and that relationship.
Last real question. If let's say, young person is hearing this conversation, talking about so much data, you've got to sift through a lot. You've got to delete most of it. You got to pay attention to a small number of very important data points. It would seem like a great use case for AI. I would say I don't have I have a hate relationship with AI. Like I think it, from a writing standpoint, it does average writing instantly, which is a miracle, legitimately, but it doesn't do great writing. I don't quite trust it yet, but I'm kind of a codger on this. And I know that if I'm in college, I'm in high school, college, whatever, and I'm building out my skill set as an investor, how much focus would you allocate to AI?
Gosh, I will say, being a professor, I work with students every day, and they use AI all the time. So
Hmm.
they're much more. It's going to be much more part of their workflow in the next 5, 10, 20 years and beyond than it has been for us. One of the things that you can do is start to have a conversation with the AI. So you might say something like, "Well, tell me what this company's economic moat might be," and it might spit out some reasonable responses. To which case you can say, "Okay, well, tell me why that particular thread or that particular theme is durable." Right? Start asking it questions and see what it comes back with. But I do think you need to supplement that sort of dialogue with AI with real world cases, I guess, for lack of a better phrase. Right? Read the great investing books, read the great business books, learn about the great founders. It should all synthesize. It should all map on each other. If there's something that AI is saying that doesn't make any sense based on all the things you read about great founders and great businesses, it's probably not as durable as you might think. And so you do have to, and that's one thing I want to stress to the listeners and also my students is just make sure that whatever you read on AI, that you're confirming it and verifying it in reliable data sources, because AI can spit out some
Oh
things
yeah.
that aren't true.
And I know I'm interviewing you, but just as my own like add-on point to that, by definition, to make money in investing, you have to be doing something different from the consensus. You have to see something the market doesn't see. You have to be more emotionally resilient, and it's a lot easier to be that than to see something the market doesn't see. The market's pretty good about seeing stuff. Somehow you have to be seeing or doing something different to make money. And in the old days, in Buffett's day, that might have been as simple as running some basic financial ratios, because nobody knew about basic financial ratios. And so if you could do a current ratio or a PE, like, you were special. After that, maybe he was getting some data. And then the internet came along. It used to cost hundreds of dollars to do a comparable company analysis, like investment banking or hedge fund. You had to order these 10Ks. And so having access to 10Ks was special, secret, institutional knowledge. Not anymore. The internet came along. Now, AI is coming along and basically automating, let's say, junior analyst level kind of stuff to a degree. So that's commodity now. You're not going to make any money doing the same thing everyone else is. You have to do it because the bar is now higher. But I don't think you're going to make real money unless you can see beyond. So it probably places more of a premium. And you may agree, disagree, or be neutral about this, Todd, but more of a premium on strategic level understanding, like seeing where the industry is really going. Where's that company really going? Because kind of the commodity quantitative basic analysis stuff, that's going to be a commodity now.
Yeah, there's three ways to make money in investing: in informational, analytical, and behavioral. And informational, I think, it's obviously there's so much information today that it's hard to say that there's an informational edge to be had. Where you might have it is what we were talking about, how there's so much information that if you're able to figure out what is the signal and avoid the noise, you might have a small advantage there. From the analytical standpoint, you definitely want to get a sense of, okay, where do I see this company in 3 to 5 years? And I've spent enough time on Twitter, X, whatever you want to call it now, in these conversations about certain companies to see how these opinions about certain companies sort of snowball and go viral. This company is doomed, and it ends up doing 100% returns over the next 3 years. And that's because it's sort of snowballs, and nobody, again, you have to be conscious of your own biases and your own emotions. And so if you're a trend follower and you start buying into what other people are saying about a company, you're never going to have the resolve, or this is the third part, the behavioral fortitude to take an investment that's against the grain. And so you have to be able to do each of those things, sort out the information, have an analytical mind about the company, and be able to, going back to the very start of our conversation, have the behavior, the fortitude to take an action when you don't have perfect information.
As a social experiment, I wonder how, if you started a Twitter account and all you did literally was join threads about certain companies and just said, this company is doomed. This company is doomed.
Yeah.
Like how popular that account would get.
Yeah.
Or you could invert it. But anyway, Todd, it has been very, very informative speaking with you. And I think this topic, like I mentioned, is totally underloved. We focus more on the what, not on the why, right? Behind every investment analysis decision should be a why. Like, why am I doing this? Why am I doing this, not that? Why am I ignoring this or focusing on this? So conversations like these, I believe, are helpful to investors. So certainly appreciate your time. If someone watching this says, I like this guy, I like Moats, and I want more of Mr. Moat, Todd Wenning, where would you send that person to learn or read more about you, Todd?
Probably the best place to follow me on social media is on Twitter at Todd Wenning, and you can always send me an email through KNA Capital. It's www.kna-capital.com.
We'll put those on the screen or in the show notes. Todd Wenning, thank you so much for joining me in this conversation today. I hope it won't be our last. And thanks to you guys for watching us at home.
Thanks, James.